I'm hoping that applause is for our audience. As you've heard, we've got some Amit all the way from London representing the UK office. We've got Dwayne from Cape Town representing the Big And then thank you, Danielle, for flying all the way from Washington. The US isn't great at rugby, but she's got Irish heritage, so we thought we'd put her... A big thank you to the panel. As I say, come a long way. But let's start with the question on location. I saw the poll, quite an interesting result. But Danielle, you're based in the US. Can you maybe, just from your perspective, Sands, does location really matter? The fact that you're in Washington or the US?
Yeah, no, I think that you can be a strong investment manager and be based anywhere. Certainly, there are examples of good and bad in all locations, but I do think that if you are an international or global investment manager, you have to really be committed to getting feet on the ground, to traveling a lot, to going in groups and doing collaborative research. And I think that's the key. So culturally, you have to have a firm that has that mindset and the resources and willingness to do it. Now, I happen to think that as a growth investor, and that's what we do at Sands, we do one thing. We invest in leading growth businesses globally, that we have a natural advantage, competitive advantage, being based in the US. First of all, you think about the global index, and it's 60%, over 60% US. Think about the number of businesses in it, 3,000, and over 70% of those are based in the US. And I would make the argument that if you think about what companies right now are the largest, fastest growing businesses, the Metas and the Amazons and the Googles and the Microsofts and the NVIDIAs. They're all based in the United States. So there is that innovation hub that, based on our location, it's easy for us to access those high technology companies that are making the innovations. And it's not just them that we have to think about, it's their upcoming competitors and their customers and their supply chain. So there is that ease. Obviously, travel still is necessary.
Well, Dwayne, I guess you kind of not a South African manager, 91's a global manager. But what would kind of your perspective be on the question, given that you kind of global manager with South African roots?
Yeah, I mean, it's an interesting one because, I mean, again, it comes back to circle of competence and what you're doing. And I mean, I agree with Daniela. It's about kind of having those feet on the ground and making sure that you actually understand those markets. And if we think of 91 global franchise that I represent, I mean, we are actually a global manager. So if you get a sense of, 91 strong SA roots, but ultimately more than 60% of our assets comes from outside South Africa. If you think of the 91 quality franchise that I represent, we've got assets under management of about $25 billion in our global strategy. More than 60% of that assets comes from top global allocators that have recognized our track record. So the first point I would make is that ultimately it comes down to investment skill. So if you look at the global franchise strategy, we've been able to deliver 3.5% alpha since inception in 2007. How have we done that? Funnily enough, our team setup is very different. So we've got team members based in New York, we've got the bulk of our global team based in London, and then you've got a few of us like Clyde and myself and Rob Forsyth that's based in Cape Town. We found the advantage of diversity of thought. So if you look at the members of our team, you've got South Africans, British, Chinese, Irish, leads to great, robust debate. And so certainly we found having that diversity of thought, having actually the feet on the ground, and being able to have robust debates, being in different locations for us has not been a disadvantage. It has actually been an advantage.
I guess JP Morgan, if I could turn the question the other way around, but you've got offices all over the world. Could you do what you do all out of London?
I think that's a great question and a great way of looking at it. And I can say categorically, no, we would not be able to manage money in the way that we do if everyone was based from one location. I know when I get back to the office, I'm within a phone call away of speaking to Paulina our basic resources analyst based out in Japan. She's Russian born, she speaks Japanese, she's lived there her entire life. I can go and speak to our semiconductor analyst, Rob Bowman, in the US with more than 3 decades worth of experience. He's based out in the US, obviously. Again, having all of these people around the world means you're gathering, and the way we like to think about it is local insights but applying a global lens. And all of those, both of those analysts I mentioned, there's more than 80 analysts worldwide, you're gathering lots of those local insights across every single sector and across every single region. And if you can all imagine it as being almost like a mosaic then, you're getting pieces of information from the semiconductors analyst who's speaking to the autos analyst covering electric vehicles, who's speaking to the basic industries analyst who might be looking at prices of steel. And you can build up a picture of what's really shaping the global economy, but you need that global basis in order to do so.
If I could just interject, I totally agree, and I think that's one way to do it. Certainly, the way we do it at SANS is we have our autos analysts and our semiconductors analysts and our consumer analysts all travel together to those places. And what's great is that when we come back, we don't have to make that phone call, that we've been on that trip together. We've seen the things, we've discussed them, we've debated the risks. And traveling in groups and doing that collaborative research, I think, is a really strong way to build consensus thinking, but consensus thinking that has been debated and pushed the envelope. Everybody brings their different experiences and their expertise, but they're able to answer the risks questions because they've seen things together. So certainly, I think that's a great way for JP Morgan to do it. They have many more resources, many more people, do many more kinds of investing, but if you're only focused on growth investing, I think that having that one office where most of the investment team works, but having the ability to travel and that willingness to travel in groups is great.
So I guess you saying maybe not so much, a bit of there's dissent in the ranks here. It's such a broad universe, and I forget who it was saying, I think in the first panel, there's 50 investable stocks on the all-share, really, accounting for almost 90%. But the global universe, the MSCI All Country World Index, including small caps, is like 8,650 companies. So my question is, you saying you can travel with maybe 7 or 8 colleagues. Is depth of resources a requirement given the increase in the breadth of the global universe?
Sure. It depends on what you do, though, too. If you are looking to have a concentrated long time horizon portfolio where you only have to own 35 of the best businesses in the world, and you're going to own them for a long time, then you can do that with a smaller group. But if you're going to be in multi-assets, and if you're going to have several different styles of investing, then I think you need many, many more people. But resources definitely play into it, just as a matter of where you're focusing those resources. So we would focus them on those innovative businesses that are large, that not only are going to grow for the next quarter or 1 year or 3 years, but we have to use our imaginations and think about what that TAM and what that technology and that disruption could be over 10 or 20 years. It really limits the number of companies that you're looking at.
Dwayne, maybe, I guess one of the biggest criticisms of South African managers, and with the caveat being, I know 91's a global manager, but in terms of number of analysts and so on, is that a requirement for your franchise?
Many things, it actually comes down to understanding your market, what you are targeting, and ultimately making sure that you've got a competitive edge. So if you think within the quality franchise, we are looking for the world's best businesses. So firstly, globally, you've got a much bigger universe. Right? But if you think of what are really those world's best businesses, we screen them down and you get to sort of sub 200 names. That's kind of stocks that we know incredibly well. We've researched out. We've got quite a big team. Our global analyst team, I mentioned the ones based in New York, based in London, and based in Cape Town, is about 20 analysts. So it's a reasonably sizable team. And you're able to then streamline those 200 stocks that we cover. We know them incredibly well. We do a lot of channel checks. But ultimately, you are running an extremely concentrated portfolio. So similar to SANS, I mean, we've got 30 names in the portfolio that we know incredibly well. And within that broader universe, you've got that call it 200 names of the short bench or the watch list that you stay incredibly close to, but ultimately they are competing for capital. And our jobs as stewards of capital is to make sure that our portfolio represents those best investment ideas. Certainly different managers would have different approach. We found that it's an incredibly competitive environment. Your informational edge, certainly with access to information, is starting to disappear. So being able to do in-depth research, having the resources to be able to look at sectors in a different way, to be able to get differentiated insights that's different from what you read in the media or sell-side research, ultimately results in competitive edge. And my point would be, it still comes down to ultimately the proof is in the pudding, and are you able to take that research process, that depth of research, and generate alpha for your clients?
Perfect. Well, I thought maybe I could show you what's happened with exchange control relaxation in the UK. Have a look at this dark blue UK versus the light blue overseas equities. Maybe we can learn in South Africa, given exchange controls have been relaxed over here. Is this maybe something we could follow? Global equities drown out the domestic market. So UK equities have almost become obsolete in pension funds. I don't know if that's going to happen in South Africa. Does it mean that when we have equity allocation, we follow this model? Bear in mind, the FTSE 100 is a multinational index. So the fact that when exchange controls were relaxed, you know, you went from predominantly UK equities to global. Is that going to happen in South Africa? I don't know. One caveat to the slide is forget the bond allocation. This is a defined benefit versus defined contribution. Regulators require you to hedge out your liabilities. So a very different market, but have a look at that percentage allocation in equities to domestic, the home buyers. So Amit, maybe you from that market, do you want to maybe elaborate on what's happening that side?
Yeah, 100%. And I think I've effectively lived and developed my career over the course of when, for UK equities managers, for fund of funds, for asset allocators, UK equities were at one point a much bigger allocation in portfolios. And you've seen how much that's dropped off, particularly over the course of the more recent 2 to 3 years in particular. So many of my conversations over the course of these last 2 to 3 years have been, what's your global equity fund doing? What's your global equity income fund doing? What's your global select equity fund doing? And the question I would pose to everyone here, and it's, I don't want a show of hands or anything, but some of you will be thinking, well, is growth going to outperform next year? Some might be thinking, is value going to outperform next year? What do you think the biggest Morningstar category is at the moment? It's global large cap blend. That means the directional view of travel as far as where flows have been going on a year-to-date basis and over the course of the last couple of years has been that blended category. People shrinking down their home bias because they don't want to think about, do I want to be overweight the US versus Europe or underweight Japan? I mean, does it matter if you're picking the best stocks? And of course, going back to what I mentioned in the first question, having research of those best stocks, echoing the points raised here as well, the depth and importance of that research, how vital that is on a global basis, will become more and more important. And it's a key question that more of our clients are asking, even though they may have had that home bias over the course of a multi-decade experience. It's changing at the moment in the UK, and you can see that filtering through.
Can I maybe just add one question to that? Because I mean, it sort of resonates for me, again, as a South African that's maybe globalized from an experience perspective. And I've got tangible experience because it's one where within Quality, we've got strategies that's focused purely on UK equities, right? And if you think of what's happened to ultimately the investment teams, the amount of assets that you've managed, you've seen a hollowing out of that UK market. Ultimately, that has resulted in very positive outcomes for clients because they've gotten more selection. Broader universe, better outcomes, better for clients. All of that is good. Where I've got to be mindful of is the unintended consequences that come with that. And we need to be mindful of that. I mean, you've seen it in the case like the UK. The UK equity market has become broadly irrelevant. Right? Companies are delisting. If you look at how much assets is in play, ultimately that is shrinking. You've seen something like Botswana that is internationalized. I mean, their local market has been decimated. And so for something like the South African market, where we are now more competitive, the global market is absolutely more competitive. If you don't deliver sustainable alpha for your clients, your business is dead. Right? So that's the party stakes. So in that increasing competitive environment, the unintended consequences for our local industry is there's going to be a hollowing out of our local equity market. How do you retain your skills within the local market? And those are maybe some of the unintended consequences that come from the changes in Reg 28. I mean, maybe how 91 has maybe to manage that, certainly having that hybrid approach of where you're allowing your team to do both SA and global, again, being able to attract talent, retain talent, and again, giving your clients the best option, which ultimately is what drives the decision, is can you set up your business to have a competitive edge to ultimately deliver the best outcomes for your clients? Because if you do not, your business with some of these changes like we've seen in the UK, like we're seeing in South Africa now, the unintended consequences are extremely negative for the industry.
Got it. The funny thing is, I think the US is the antithesis of this, because you've always got S&P 500 mandates with EFI, so everything ex-US.
Yeah.
And you manage, I think, an international portfolio.
Yes.
Why is the US so different?
I mean, I think the obvious reason I would say is the size of the market, both in the population of the United States, but also the depth of the market. So the number of companies that are there, the country is large enough to support that. But those companies are not in very few sectors. We have a wide range of businesses in every sectors, from consumer to financials to industrials to materials and energy and metals and mining. There's a wide range, and you want to be, if you're going to be highly exposed to any single market, it's really important that you get exposure to many different sectors. You don't want to be singularly focused, and I think that's the key.
And then maybe just a follow-on question from this. So you've got a home bias in the US S&P 500 mandates. How do you take some of those learnings you were talking about, NVIDIA, etc.? How do you actually then maybe extrapolate those learnings into the global environment then?
Sure. I think it's experience and expertise that have been built up over many decades. At Sands, we have a 60-person investment team, and yet we only own about 120 names across 4 flagship strategies. But our team has been working together. Many of us have been working for a decade or 2 decades together. So there's that built-up experience, that shared context, that shared accountability. I think that is very important. But most importantly, because we do focus so narrowly on growth, and global growth specifically, we're able to go really deep and build up domain expertise in areas where we see secular shift happening. And so secular shift often isn't relegated to just one single market. It may happen in one market first, but then it expands throughout the world. And a big benefit or the greatest skill that you could have, I think, as being an investment manager or an investment analyst is pattern recognition. And so if you've been doing this for a long time and you've seen it happen in this market, and you're able to use your imagination about how this could play long-term in other markets as well, or how this technology gets adopted, or what are the risks of that technology being adopted, I think that's how we do it. Pattern recognition and built up expertise and shared context over many years.
And then maybe, Amit, if you're talking of experience now, one of the most experienced managers is Helgi on your global equity team. Can you maybe just talk about your experience and also, succession planning, something like that?
Yeah, absolutely. And it's one of the key tenets that we have at JP Morgan Asset Management is, rather than a star portfolio manager culture, we have very much the star analyst culture. And I already alluded to that there. But again, echoing very much the points raised earlier, that collaboration across teams is very important as far as reinforcing that goes, where you do have investors with more than 3 decades worth of experience. You've got a process there in place which has been around for almost 4 decades. And on top of all of that, you've got rich data sets which, as data science evolves, as artificial intelligence evolves, as analytical techniques evolve over time, you can utilize that data set in much more powerful ways. But more than that, just on the humane side of it, the actual personnel-based side of it, it's so powerful for, say, junior team members, from our research analysts, to have a Rob Bowman with 3 decades of experience, a Helgi Skibelli with 3 decades of experience, be able to put their arm around them and say, look, this is the cycle. We've all gone through this. Don't panic. Stick with your ideas. If you need to adjust them, fine, but don't panic. And having that level of expertise, that mentorship there is one of the key areas which we try and reinforce on a cultural basis across the equity platform. The ultimate aim of it is arriving at differentiated insights. You ultimately want talented people to have the scope and the ability to do that around the world and arrive at those differentiated insights and creating a culture around them to do so.
I can't help but notice you both nodding. Can you give me your experience of this experience?
Yeah, so I mean, it kind of resonates. Because I mean, again, someone who manages a team, you get to see with an analyst pool, there are various arrays of experience. And you get people who are hungry, they are passionate, but they come with different forms of experience. And again, you can see I've kind of lost my hair. 2 decades in the market. You've got to keep it short to hide the bald spots. But I've seen a couple of cycles. And it's quite funny when you see within our team, super smart youngsters that have started, all they've lived is a period of low interest rates, free capital, and thinking that certain things kind of only go up, right? And having some of the old timers like myself and Clyde that has seen a couple of cycles and being able to help the youngsters understand about the importance of cycles, the importance of asking the questions around what could go wrong. It's in a world that is so competitive and information is changing so fast. Again, having to digest things. I mean, there's the whole adage that history never repeats, but it does rhyme. And certainly you think through things like AI right now, which is quite topical, and the youngsters come through and they are so far ahead, and you've got the old timers that's trying to catch up and get on top of all these trends. But where the value that you add, having the diversity within your team, is being able to ask the right questions. Because I mean, the one thing I've learned in my career is things change all the time, but ultimately, you're trying to solve for the same problems. So having the gray hair or the no hair in the room, asking the right questions about what could go wrong, have we thought about this risk, does bring an element of balance. And certainly seeing what we've seen now with the record rate hikes we've seen certainly over the last year, and certainly what some of the stocks have taken in terms of the pain, some of the exuberance of the youth in terms of what they thought that some of their stocks were bulletproof. Now maybe some of that reality sinking in.
Got it. And then I guess it's a very diverse panel on multiple fronts, but also on ownership structure. So when we delegate mandates, the big question often comes up, well, should you delegate a mandate to a boutique or privately owned or bank owned, etc. Now, fortunately, our panel is represented across SANS being privately owned. I wonder if you could maybe tell us why being privately owned gives you an edge, and then we'll get the same from the rest of the panel.
Yeah, I mean, I think coming out of the last few years, the difficulties of COVID and the reaction of the market after COVID, being a privately owned business, the way we do our research, the way that we operate didn't change at all. We were still, despite the fact that revenues were down, we were able to go out there, get on the road, travel in our packs of groups, and we didn't have to justify our expenses. We did our business exactly as is. I think the other benefit of it is it's privately held by the investment team and the founder of the company and many other members of the SANS team. And so it really aligns us with our client interest. And we want to do what's best for clients because when clients make money, we make money.
And then I guess you're the antithesis of that, Emmett, is, or prove me wrong in the sense you owned by this behemoth bank. Is budget not a problem for JP Morgan?
Budget is not a problem for JP Morgan. We put 150 million, or more than $150 million behind our research budget for our analysts worldwide. And that pays for them to be able to go and visit an oil field in the Permian, or a consumer conference in Asia, or wherever else it might be. But the real power behind the platform isn't how that budget is used for travel purposes, it's that one unified platform there. And again, it's always described as a behemoth, as being an absolute monster in terms of the resources and capabilities available there. But unless you have experienced managers there being able to narrow that focus down and actually direct it at stock ideas, it's almost all for nothing. Like, numbers and everything I've mentioned is not the secret sauce. I go back to the point on culture I mentioned earlier. I go back to the point on depth of coverage as well. But to answer your question, no, I mean, we're never hobbled in terms of almost the bureaucracy someone might imagine within that large organization from an investment perspective. we implement quickly, we can move alongside those structural changes within markets, and we look to capture those when it comes to actually delivering outperformance then.
And then Dwayne, you're kind of a hybrid.
Yeah.
Tell us your view.
Yeah, so I mean, you heard earlier from Hendrik, I mean, there's advantages and disadvantages to being a listed player. I mean, certainly from my side, I mean, I would say it all comes back to alignment. So how do you incentivize your team to ultimately deliver what is the best outcome for your clients? So how 91 has done it is we've said our bread and butter is our clients, right? So without clients, we don't have a business. So option number one is you've got to deliver the alpha that keeps the clients there. How do you then incentivize the team? Right? So make sure the team is incentivized to ultimately deliver the outcomes for clients and make them owners. So if you think of 91 as a listed business, you can be owners in the business, you can be locked in and ultimately share in that upside. But I mean, the key thing is to cut out the bureaucracy, make sure your teams are aligned, incentivized, and importantly, and I think this is where it ultimately fails, as long as you've got complete alignment with your clients, ultimately it's one where the team will be aligned because you know and you're striving and you're all rowing to achieve the same thing. And if you know if your clients win, ultimately you as an investment team wins.
Got it. Well, I guess we need to look at the proofs in the pudding. We've got two peer groups over here. One's the Morningstar peer group, the blend category that Amit was referring to, the largest, the biggest tractor of flows at the top. The average manager, what have they delivered versus the South African peers, much smaller universe, obviously, but obviously got global peers within that. And over 3 years, the difference is almost 1% annualized. So essentially what we're seeing over here is global managers outperforming South African managers that are offering global. Now that doesn't necessarily mean that an analyst sitting in Cape Town or PM in Cape Town can't really compete with somebody in Washington or London. I think this could maybe come down to fees. And that's something that I think INN8 actually offers in our new model is the US has had passive for 30 years, a lot of competition, and we can actually get really aggressive fees in the global market. So I think that partly explains the underperformance of the South African universe. But I think to conclude, the numbers probably speak for themselves. I think to elaborate, I don't think if you're based in a particular region, you are more stupid or can't compete with an analyst somewhere else. I think maybe sometimes it's about perspective. And I think of Tesla. I'm based in London and there's just Teslas everywhere. I've come here now and I haven't spotted one Tesla. I don't know if that's because we can't charge them as a result of load shedding. The reality is, Danielle, probably her experience in that market is going to be very different maybe to Dwayne, who won't be driving one. So just different perspectives. And I guess we've probably run into lunch and I can hear a few tummies grumbling. Thank you very much for attending, and please, flown a long way, Danielle, from Washington, Cape Town, London. Thank you very much.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.